Friends, as you know, we have been discussing about various products, functions, services of the banking sector. So we'll be quickly understanding all of this in our current session. Maybe in coming around 30 minutes, we'll be discussing all that. So let us start the session. You must be seeing the screen. I have already shared the screen with you. So plan is that we'll be learning about banking services, banking products, and the recent trends in the banking sector or banking industry. So you must be familiar with various products of the bank by now. You already know. First, let us see the services which are offered by various banks. Payment service is one of the various very important service that through banking system we are able to make payment. This particular service enables us to transfer funds from one place to another place, to one person to another person. Many times, we all of us use this facility. Let us say we make DDs to transfer, or we make online transfer. We pay utility bills. This is one of very important concept. So banking channel, this particular service, banking channel offers this service, which is very helpful to all of us. And this is one of the important services, payment service. And you must have heard of one more service, which is called as the overdraft facilities. Mostly, you might be knowing some of the businessmen use these facilities. They might be having one current account on which this overdraft is allowed. That means they are eligible to draw some to overdraft. Meaning, if they are having a credit balance of 5 lakh, they can draw, let us say, 5,20,000. So there is a limit. Normally, one only limit is fixed, and within that, that person can withdraw money. The extra money which is withdrawn, that will be treated just like a loan, and interest will be charged on that overdrawn amount. So that is one more facility which is very helpful to the businessman. Money is not there in account, but still they can use the OD facilities and make payment. That's a good system. Then currency exchange. So many bankers they also work like a forex dealer. So if you're having foreign exchange, they may exchange it. Or if you're having Indian rupee and you want to get it converted in foreign exchange for whatever reason, that also they can do. They work like money changers or currency dealers. So this is one of the important services that also banks perform. Not that they give hard currency, they also give travelers check in different currencies. So that is also very important service they perform. The consultancy service, you might have heard of that. Sometimes banks also hire financial professionals, legal experts to evaluate deals, to let us say to conduct a kind of due diligence on the business transactions. So this is how they offer consultancy services. Okay, some banks do that on the request of the customer. Sometimes also before sanctioning loan, they do various kinds of analysis. And in that process, they also give consultancy to the customers that you see your financial position is not that good. It needs to be improved. This ratio is not good, like that. So this kind of analysis they make, and on that basis, they provide these consultancy services. And this next service is about online banking. All of us are quite familiar. We use it day in, day out. We have been using this facility. So 24/7. So various online transactions we do, payment money, purchase of things, shopping, many things we are able to do through online banking. That is an important service. Mobile banking, one more service, day by day it is becoming more popular. By use of certain apps, smartphone apps, you are able to perform your banking transaction through your mobile. That's also a service. Home banking service, that is also useful in many situations, specifically elderly people, senior citizens. So if they want banking services, that services can be delivered at home. That is home banking service. That's also one important service. Credit card, debit card, you already know it. If you are already having a balance and if having a debit card, using the card, you can withdraw money, you can make payment also. Credit card also means a certain limit is fixed and a card is given to you. Within that, you can use the credit card. Okay, and this much money is allowed to you, or you can say just like a loan, and within a particular time you have to pay. If you are not paying, then interest will be charged. Till that time, till the credit period, which is normally 45 days, no interest is charged. After that, if you do not make payment, then interest will be charged and other charges will also be levied. Locker facility, that is one more important thing. Banks offer this locker facility where you can store valuables. Your valuables can be stored. Papers, jewelries, all these things can be stored, and locker rent will be charged for that. But rent is normally a minimal fees is charged for locker rent. Money transport, demand drafts, pay orders, money orders, checks, online banking. So many options are available with a banker to transfer money. That's important service. Investment service. Banks also helps customers for making investment. They have various investment options. They also give advices in line of investment. They also ensure that investors' wealth is getting maximized. So wealth management is one more important service. So banks also sees that the customer wealth is getting maximized. In connection to that, they provide various auxiliary services like making mutual fund products available, insurance products available, selling gold coins. So many things are there. So many, you can say, services are offered by bank, which are, you can say, something in nature of auxiliary services. Indirectly, they help in wealth maximization of the customers. So these are, in fact, the list of services we have seen in the banking industry. If you have any queries on this list of services, if you have anything to ask about banking services, tell me right now. I'll be addressing it maybe after some time. Okay, got some fair idea that these are the services offered by a bank. Now, having covered this, now let us see various banking products. This also some basic idea you must be having. By this time, you already know a group of products are called as loan products, and a group of products are called as fund. Maybe your deposit products, you can call it. From bank's point of view, if you see that for the bank, when loan is given, for the bank, that is an asset. When bank gives a loan, that is an asset. And when deposits are made, suppose we are depositing money in the bank, from bank's point of view, that is a liability. Is it not? So from bank's point of view, you can analyze there are some products which are called as the liability products and some products which are called as the asset products. Okay, so every bank has various products in their menu. So under loan products, various loans items are there. Similar on deposit products, various deposit items are there. You already knowing, let's say fixed deposit, saving deposit, current deposit. Okay, let's say recurring deposit, flexi deposit. So many deposit products are there. Similarly, loan, vehicle loan, home loan, cash credit loan, working loan, or maybe simple term loan, like this. Various loans products are. Okay, so now let us learn what are the products of the bank. Let us see. Oh, there is one more classification of the products also. You can say bond-based and non-bond-based. Non-bond-based means fee-based. When you say bond-based, that means bank's bond is involved. Bank is giving money. Suppose you are taking a loan. So bank will give you money or not? Bank's money is involved or not? Tell me. You want a loan. Bank's money will be involved in that or not? Can anyone reply?
Sir, the customer deposited that money given to the loan.
Sorry. Question is that when you are taking a loan as a customer, you are taking a loan from the bank, whether bank's fund or bank's money is involved in that or not, or bank's money will remain intact. What will happen? Try to understand when you are taking a loan, the bank has to pay money. So when the bank is paying money, bank's fund is getting affected. So therefore, whenever bank's fund is getting affected, you can say they are the bond-based product. Bond-based product. Bank's own money is going out. But let's say you are going to a bank and you are depositing money and immediately saying that give me a DD. Here, bank's fund is not in. Your money is getting transferred. Bank is charging a fee for that. So that is called as the fee-based service. So certain services are bond-based, certain services are fee-based. Okay, bank is charging a fee only, but money bank is not giving. It is your money. Are you getting? So like this. So coming to products, there will be some products which are fee-based, some products which are bond-based. Okay. So and also one more classification like loan products and deposit products or asset product or liability products. So let us look into all this. Yeah, as I was telling you. So first of all, we'll see what is deposit product. Deposit products are referred to as a liability product because for the bank, they are in fact liabilities. For us, it is an asset as a deposit. For bank, it's a liability. It's a liability for the bank. Okay, bank accept deposits to increase. Banks accept deposit and pays interest on that. And bank uses that deposit money as its own fund. The same money is used in giving loans. Okay, so bank collects interest from the people who have taken loan, and bank pays interest to the people who have deposited money. So in between, whatever remains, that is bank's net interest margin or NIM, NIM, that is popularly called as, that is NIM, net interest margin. So net interest margin is the bank's income because bank collects interest, bank pays interest. The difference is NIM. Are you getting it? Whenever you are depositing some money, bank pays you interest. And the same fund is used to give loan to somebody. So bank collects interest. The difference is here is the bank's net interest margin. Okay, or NIM. Are you getting it? Now coming to loan products, you can see there might be deposit. Just now coming to deposit products, there might be demand deposits, time deposits like current account deposits, savings bank account deposits, recurring deposit, fixed deposits. This is how you can classify them. Right. So demand deposits means any moment it can be withdrawn. It is payable on demand. The customer demands, bank has to pay it. Okay. Under that, first popular deposit is savings bank account deposit. Right. So that means anybody can open a fixed savings bank account and deposit some money. But in this account, banks pays some interest. But number of withdrawals are limited, restricted, not limited exactly, restricted. If you withdraw more number of times, you might have to pay some charges to the bank. And individuals, HUFs can open a savings bank account. Okay, so they can enjoy the liquidity of money any moment they can withdraw. So there is no restriction as regards to number of deposits. Any number of deposit transactions they can make. Interest is paid on daily balances. On daily closing balance, interest is paid. If the minimum balance falls below a fixed limit, then bank charges some money for that. Current account is a different kind of account where you can make any number of withdrawals. No interest is paid in this account. With number of deposits, number of withdrawals are not restricted. Any number of times one can do it. Interest is not paid, but bank charges some maintenance for maintaining the accounts. Bank prescribe minimum balance that has to be kept, otherwise charges will be levied. And some current accounts are attached with OD facilities. That means money can be withdrawn more than the balance. Overdraft facilities are allowed in current account. Term deposit is one more kind of deposit where for a fixed period or for a fixed term, money is deposited and interest rate is normally higher. It can be a recurring deposit. That means at the end of every period that has to be deposited, let's say monthly, you are depositing something, or quarterly, you are depositing something, or half-yearly, you are depositing something. Fixed amount, but recurringly, you are depositing. That is called recurring deposit. Or one time you are depositing and maturity value you are collecting at the end of the period. That's called as a fixed deposit. Recurring deposit means at the end of every period, you will be depositing some amount, fixed amount. That is a recurring deposit. For January, February, March, every month you are depositing something. Fixed deposit, once you are going to the bank, depositing something. Okay, and when it's mature, you are withdrawing that thing. That is called as fixed deposit. This is how deposit products can be classified. Coming to loan products, there are many loan products are there. Banks, in fact, takes a lot of risk as regards to loan product. So banks gives into consideration the safety aspect, liquidity aspect, profitability, purpose for which loan is given, then diversification of the risks and security of the loan product. Keeping all these things in mind, so bank decides whether the loan is to be given or not. And also there are some priorities for the bank. Banks are required to give some advances to priority sector. They are also required to give some advances to the weaker section of the society. All these things, their own social responsibility aspect also. All these things keeping in the mind, bank decides its loan product. Okay. Yeah, and coming to this loan product, as we are discussing, we can again classify them as bond-based credit facilities and non-bond-based credit facilities and non-bond-based lending. Bond-based lending means banks' money will go out. Non-bond-based lending is banks' money is not going out, but bank is still giving some services. Okay, so bond-based credit facilities like direct loans to customers. When loans are given, it's a bond-based because bank's money is in. Where a bank is giving a bank guarantee or BG or a letter of credit, bank is not giving any money. Bank is only providing a service. Bank charges a fee for that. So that is not bond-based lending. That is, you can say fee-based service. BG and LC. BG stands for bank guarantee. LC stands for letter of credit. Okay. And various kinds of bond-based credit facilities are available. One is cash credit. Many businessmen have this facility. It is like a running loan, you can say. So a account holder can offer some securities like its own stock, one debtor, etc. to the bank. Some debtors and stock can be offered as security. And against that, bank can give a finance, running cash credit facility. This is just like an overdraft, you can say. So money can be withdrawn from this account. Okay, it's a running loan and interest will be charged on the basis of outstanding on daily basis interest will be charged. Okay, the difference between OD and CC is that OD means if you're having a current account and OD facilities is there, you can overdraw it. CC is a different account altogether. It's a loan account, running loan account. Okay, one CC limit can also be fixed. Banks normally fix a CC limit. Within that, you can use that facility. If you want some money, on daily basis, you can use it. That is called as cash credit. Bill discounting, which you have studied accounting, some of you might have studied, that when a supplier raises an invoice that is accepted by the recipient, then that becomes a negotiable instrument kind of thing that can be discounted with the bank. Bank will give some money against that. Okay, it depends upon the value of the money. So 1 lakh rupees, suppose bill I have done and you have accepted that thing. So bank, I can take that bill to the bank and get it discounted. But bank may discount it, let us say, for 80,000. That is, bank will give for 1 lakh worth bill, bank may giving me 80,000. Okay, on the date when the bill will mature, the person who is supposed to pay, let us say you are supposed to pay, you have to pay it to the bank. That is the process. This is called as the bill discounting system. Okay, then other fund-based credit system includes working capital loan. So every business house, every entrepreneur needs working capital to meet the day-to-day expenses of the business. Term loans might be required to buy the current non-current assets or fixed assets, but working capital is required to meet the running expenditure. To meet the running expenditures, banks give some loan that is called as working capital. Packing credit loan, it's also kind of loan. So these loans are made available against export orders. Suppose a customer has some export orders against them, this packing credit facilities will be allowed to them and they can use this as a loan. Okay, so that they'll be able to meet the cost of export. So products can be exported. That is called as packing credit facility. Buyers and suppliers credit. A buyer and supplier can avail credit facilities for the bank. That is called a buyers and suppliers credit. It is just like a normal loan. A buyer has taken or supplier has taken. Term loan is a different kind of fund-based product. It is for a fixed term. Suppose you are taking a housing loan for 20 years. So that means fixed term is for 20 years. So that's a term. So normally for acquisition of fixed assets or non-current assets, these term loan facilities are used, right? So interest rate varies. Normally it may be fixed interest rate, maybe floating interest rate. Normally people pay these term loans through EMIs, that is monthly installments they pay. So this is how term loan is repaid. Working capital facilities. This is again a, you see, working capital can be a long-term requirement, can be a short-term requirement also. So if you have studied financial statement, you know, a part of the working capital is called as permanent working capital. Permanent working capital can be arranged through a term loan also. And the other working capital, which is not permanent in nature, which is actual real working capital, that can be managed through cash credit facilities or any working capital. So this is working capital facilities, another kind of loan, which is a short-term loan. But previously what we have studied is working capital term loan. It is for a long-term. Long-term loan means it is for permanent working capital. And this working capital facilities, what I'm showing you right now, is for short-term, to meet the short-term requirement. Coming to non-bond-based credit facilities, so two popular things are there. One is bank guarantee, where banks gives a guarantee or gives a commitment in the approved format, right, on behalf of the customer with third party. Many times you might have seen when tenders are published in the newspaper, they say the participant has to submit this much amount of BG. That means bank guarantee has to submit. You don't deposit money, but you have to give a guarantee from the bank. Why it is taken? Suppose in case you fail to perform, suppose tender is awarded to you to construct a flyover and you fail to do it, then money will be recovered from you. So therefore, a bank gives a guarantee. So bank charges money for that. If you want a BG, bank will be charging some money for that. Okay, bank may insist other things also. Deposits, it makes a big deposit, against that I will be giving you BG, like that. So that is the guarantee that banks give. So here you see practically bank's money is not involved because bank is giving a letter only, a guarantee paper. Bank will earn some money as charges. So therefore it is called as a non-bond-based credit facility. Okay, banks gives you a commitment only. This is one non-bond-based credit facility. Okay, and with the help of this, it becomes easier for the people who are participating in the business deals. They can enter into the appropriate contracts and business transactions can be executed. LC, or letter of credit, is slightly different. It is more popular in export-import transactions, but it is also used in domestic transactions also. Various kinds of LCs are there. Normally what happens, this is an assurance to the buyer that he will be receiving money. Normally in the export transactions, so seller feels that if I give money in advance, then buyer may not dispatch goods. Buyer feels if I dispatch goods fast, then seller may not pay. So to reconcile both the issues, what happens normally? So one, this particular document, letter of credit, is used. The purchaser, the buyer, gives a letter of credit from the bank. In fact, in summarized form, if you would like to say, it is something like that. Bank is saying that you allow credit facility to this person. He is my customer, and you can sell products on credit to him. And if he doesn't pay, I will pay. So there is a standard format in which LCs are drafted. So if you look at here, this particular picture, here you see, here is the buyer and here is the seller. Buyer will approach his bank to give an LC, letter of credit, and letter of credit will be sent to the seller. This gives a comfort to the seller that money will be received. If the money is not received, that bank has given the letter of credit. Okay, so what will happen? This particular seller may discount this letter of credit. Seller may go to his own bank and discount it. Okay, and this bank will be collecting the money in case of transaction fails, the party doesn't pay. His bank, that is seller's bank, will be collecting money from buyer's bank. This is how it happens. That means buyer normally gives a LC to the seller. Seller can keep it, and if you want, seller can give it to the bank and get it discounted and get some money immediately. This is how letter of credit facility works. This is again a non-pawn credit facility. Okay. So now, friends, you have seen various kinds of loan products and deposit products. Loan products, banks evaluate very carefully. He looks into the security aspect. He looks into the guarantee aspect. He looks into the social pressure that can be, if that can be created on the person if the person doesn't pay. All this aspect he takes into consideration. He also takes into consideration whether the person has the ability to pay, whether the person will be willing to pay. All these aspects it takes into consideration. After that only it sells the loan product. Okay, and there are some sectors which are referred to as priority sector. So banks are supposed to give a certain percentage of the loan in private sector like agriculture, MSME, small business, retail traders, professionals, educational loans, vehicle loans, like this. These are the priority sector lending. Some money can be advanced to this sector. Okay, so this is about various kinds of products we have seen in the banking sector. Now, lastly, we'll be learning about recent trends in banking industry, which again you must be familiar with. I'll be only telling you a few points, but you know most of this. One is you must have observing that nowadays most of the payments are happening electronically. Okay, whether you call it as NIFT or IMPS or any kind of e-payment you talk about. So that is a very recent development. So the check system is in fact becoming obsolete, and it becomes easier. That is, you can say very conveniently, you can observe that payment system has been changed. Electronic payment is more and more electronic payment happens. Okay, and one more important thing is the real-time gross settlement or RTGS payment. That means instantly money can be transferred. So in case of check, what happens? It takes some time to be credited in the recipient's account, but here instantly on real-time basis money can be transferred. That is one more development in the banking sector. Okay, ETF, electronic fund transfer. Many times we give standardized instruction to the bank that every month and this month money will be transferred to that account. Okay, so that is a good system. Similarly, electronic clearing service. This also can be used for making fixed payments, retail payments, etc. Periodically, electronic clearing service, that is also a recent development. ATM, all of us use it 24/7. We can withdraw money from this ATM. We can deposit money also. Okay, we can get information about our balances through ATMs. So this is again becoming very popular. POS or point of sale terminal, you find many places, many shops, petrol pumps. You can just swipe your card and get the money transferred from one place, from one person to another person. So that is also becoming day by day more popular. Telebanking, okay, or by using AVR, that is automatic voice recorder, or by downloading suitable app, by using various apps, you can do banking through your own telephone also. EDI, that's electronic data interchange, electronic exchange of business documents, that also can happen electronically. Let us say invoices can be transferred if it is in a specific format. All these things are happening in the banking industry. Flexi deposits, that is, which is a mixture of your demand deposit and fixed deposit. You can open an account. If the balance exceeds a particular amount, automatically it will transfer to a fixed deposit. So this is also a new product. Reverse mortgage, we are discussing about it earlier. So reverse mortgage is what happens. So bank will, this is in fact useful to any homeowners or senior citizens. What they can do, they can reverse mortgage their asset house, and they can take a loan, or either the loan can be taken periodically or an installment. And every month they may receive something, or at a lump sum they can take the money. Okay, at the end of fixed period or upon the death of the person, the building will be taken by the bank. That is the process that is called as reverse mortgage. Okay, it is opposite to the normal mortgage or forward mortgage. Forward mortgage, what happens? Bank pays money fast. Asset is mortgaged. Here what happens? Banks pays money normally periodically and acquires the asset at the end of the period. Okay. And in case of reverse mortgage, the person who has taken the loan is it's not required him to pay back the loan. Bank will take over the asset. So these are the various recent developments. So of course, some other points also we have been discussing earlier in the banking industry. Recent developments like use of artificial intelligence in various areas. Then more and more internal controls are implemented so that transactions become more safe and more secure. So these are again some recent developments. Okay, so this is broadly what we covered about banking services, banking products, and recent developments. You have any query? Now we have time. Please ask me freely. I will try to address those queries. Any query you have?
No, sir.
Okay, then with this, that banking part is over. Thank you very, very much.